Well, hello there, everybody. This is Morris from San Jose Options. You can find us at sjoptions.com as well as sjadvisor.com. In today's presentation, we're going to be looking at the put vertical credit spread. We ran hundreds of back tests for you, and we'll be sharing with you the results of the back tests in today's forum. How many of you have traded the bull put spread? This is one of the most popular option strategies of all time because it's very simple, it's easy to execute, and the brokers love it. There are many ways to do the credit spread, and today we're going to be looking at a design that's just out of the money. In the next slide, we'll take a look at the structure of the put vertical credit spread that we back tested for you. Here you can see a bull put spread that's just slightly out of the money. We placed this trade 45 days out from expiration, and we sold approximately the 46 delta of the puts. Then we purchased near the 43 delta to complete the credit spread. This gives us a fairly large credit overall, about 1/3 the width of that credit spread, which you can see from the risk profile on the screen. So if you look up here, you'll see that the white area, this represents the profit potential of the trade, and then the gray area is the loss, and the credit brought in the trade is about 1/3 the width of the entire spread. Now there are lots of ways to trade the credit spread. Many option traders enjoy doing the credit spread farther out of the money, such as a 5 delta or a 10 delta, and that type of trade will give you a small reward for the risk. By moving the credit spread in closer to the money, then again you're changing that risk to reward ratio quite a bit, and then in this case you're getting about 1/3 of that credit compared to your risk. So when you trade this way, you can actually make over 30% on one trade, but the trade-off is the probability is lower. So this credit spread, again, since it's closer to the money, the probability is lower. We collected a great deal of empirical data for you, and we'll be sharing that with you today. But considering we sold near the 46 delta, you would think the probability of profit of this trade would be somewhere around 56%. That's a formula that we use as option traders as a rough estimate, 100 minus that delta. And with a pop, the probability of profit, the pop, of 56%, then the average winner of this trade should be greatly more than your average loser. If the numbers are fairly close, then this strategy most likely will not produce positive results long term. Also remember when you're actually deploying an option strategy, and also when you're backtesting, your results highly depend on the order in which the profits and losses occur. So for example, if you go through a period where your trade or your trading system loses a lot of money consistently, and then it's followed by many winners, the system may still end up being a non-profitable system because when it's making the money, it didn't have as much to invest. And so if your trading system loses first and then the wins follow, then you could still end up with a loss, even if you have more winners. Like even if your average trade is a winner, the whole system can fail. So that's one thing that we have to remember when we're testing a system. In this test, again, we followed the popular saying that trade small and trade often to let the law of numbers work out. So we did that. We ran several different tickers. Actually, we ran 6 different trading products, which we'll show you in the upcoming slides. And then we used 10% of the portfolio in each one. So this trading system, we used about 60% of the capital of the portfolio, and that's pretty typical. Most option traders will definitely leverage those accounts. So we're only using 60% of the capital in today's test. The popular belief. The credit spread is the ideal set it and forget it strategy. Have you ever heard that before? Again, this is definitely one of the most popular option trading strategies of all time. Usually it's done out of the money, as we talked about before. At today's test, we're closer to the money. We're going to test this other idea of bringing in more credit and leveling that risk to reward a little bit more, but lowering the probability. We want to see how that's going to work out. So we're going to start to talk about the results pretty soon. First, I want to show you the tickers that we tested for you. So we ran a test on SPY, IWM, Apple, Google, SPX, and the Russell. These are very common, they're very liquid, and so they were good for us to test. I'll also add that we tested from 2002 to 2016. Again, when you're running a test on a trading system, you want to include as much data as possible, and that's what's available to us through our historical database. So really up to like 15 years on each symbol. We added some more rules to the test. So each trade is only initiated when the IB rank is from 50% to 100%. Again, this is being taught through the industry, so we wanted to test this theory. We used 10% of the capital, as I mentioned before, and we sold the 46 delta of the put, and we bought the 42 delta. We also added in some money management rules. So we're taking the profits if the credit achieved is 50% of that original credit, and then we're going to stop the loss if that original credit doubles. Again, these are very popular rules that are being taught throughout the industry. So now we get into the trading results. Again, over the 15-year span, we had about 62% winners on average. You can see that the SPY resulted in 61% winners, IWM 60%, Google 62%, Apple 57%, SPX 59%, and the Russell 66%. We actually ran 358 total tests, again from 2002 to 2016. Currently we're in May of 2016, and the number of tests were again limited to the rules. The volatility rank had to be between 50 and 100. Also note, mentioned before, all the trades start with approximately 45 days out to expiration. So we had to meet all those criteria to initiate a trade. Next, we're going to look at the average return per trade, and you'll see that the system, when you start to look at the results, you'll see why it starts to fail. So the SPY, the average return was a negative 4.4%, IWM negative 3.1%, Google a positive 7.6%, Apple 0.2%, SPX negative 2.1, and the Russell negative 1.5%. You'll also see that the SPY and IWM lost more, and it could be due to the commission expense. We did add in $1.50 per contract. Next, we're going to look at the SPY a little closer. The average winner of SPY was 31%, while the average loser was 61%, which makes sense according to those rules that we set up for the backtest. If you're quick with your math, then you can probably see the problem developing with this trading system, with approximately 62% winners were left with 38% losers. So mathematically, this trading system looks like a poor design. We'll break it down a little bit more in the next slide. So we see that mathematically, the trading system comes out to a loss of 3.96 if we perform about 100 tests. Now, again, as we discussed earlier, this would assume that you have the same exact amount of capital in your account all the time, which is obviously totally unrealistic. So as you trade through in real life and trade through a back test, then again, if you have a period of consecutive losers and then your net liquid drops a significant amount, then the winners are going to make a lot less. And so in reality, the loss of 3.96% will not be accurate because the change that's going on in the portfolio value as you go through time. But we can just see that mathematically the trading system comes out to a loss. And that this would assume, again, that the account value is the same the whole time. So these are the actual back-tested results. So again, from 2002 to 2016, just running the system and allocating the 10% of the portfolio as we went through time. And again, this is a real back test, so as that account value went up or down, then the investment amount went up or down. So your SPY actually ended up losing 47% over the long-term back test. And IWM actually came out almost exactly the same with a 47% loss. You can see that the losses are greater there, and the difference could be the commission costs. Google was the best winner, came in first place with a 16% gain. But again, over the long period of back testing, it made, I don't think this one Google back tested all the way to 2002, but it made maybe a couple percent yearly. Apple lost 18%, SPX 32%, and then Russell, again, by the order of the trades and the profits, came out to a 7% gain. Then we added up all of those returns together, and then the total was a loss of 121%. So again, over the 15-year span, you can see that if the trader was working with this particular credit spread trading system, then slowly they began to burn through their capital. Unfortunately, though, most traders deposit more money into their accounts every year, and so as that happens, they're losing more and more. So again, here we see a loss of the entire account, but if the trader had invested more money, then they could have lost even more. This credit spread system will, again, cause those losses to happen rather slowly, so the option trader will be able to continue trading the stock market for a very long time, especially if they replenish the account with more capital. And so again, this trading system will profit the broker handsomely, but it's going to leave the trader slowly bleeding through their life savings. Adam Sandler says it best. So why does this trading system fail? Let's take a look at the risk profile once again so you can visualize why this system does not work. So if you just look at the graph, the trade design is really, it's a gamble. If you, again, look right here, the day step line, you can see as the market drops down, the trade is just losing a tremendous amount. The 10% mark is actually way over here. So in the event of a flash crash, for example, or just 2 days where the market goes down 10%, then the trade is really wiped out and loses everything. It loses 100% on that trade. As you move this way, then the trade again can make 30%. But easily, the market can move within 1 day up here and you can make maybe 15-20%, or you're down 15-20% with a single move. So if you think about it, when you're in this type of trade, it's going to be extremely volatile. You're going to have, again, swings could be 5, 10, 15% very easily. And so it's just really a roller coaster ride type of trade. It's fingers crossed type of trade. And it's just definitely a gamble by design. Very risky. So why stay stuck with popular strategies such as this one that do not work? The SJ options and SJ advisor methods have been back tested, and our methods back test much better than this. And then we've been forward testing our methods for many years now. In our back test, in one of them, and I just ran it again last night, one of our systems that we teach in the portfolio margin course back tests with 94% winners. And the risk to reward is really, really good. And the average winner and average loser are very close to the same. So with that type of trading system, then the numbers work out in your favor. In this presentation, we're able to see that the credit spread, at least this one that we're analyzing today that's closer to the money, did not work out. And remember that your condor is really two of these credit spreads together, and so most likely the credit spread is going to have the same problem. Now also keep in mind that we did apply those rules that are being taught by the brokers with the high IB rank and the stop loss rules that they apply. Again, why stay stuck with popular strategies that don't work? Over the last couple years, we've been forward testing our latest method, and we've had 100% winners in 2014, 2016. We've just completed 100 winners in a row. I remember when we arrived at 10 consecutive winners, and I thought that was a lot. But now with the refinements of our strategies, I see it's possible to keep on going without losing for a very long time. The only thing that could really slow us down with our trading system is the broker. As you know, does not always want to fill your trades. If not for their resistance, option trading would be extremely easy, insanely profitable for everyone using our trading methods. And really, that's just the truth. The broker is the only thing between our clients and their true happiness and success, just making a killing on the stock market. Somebody asked us, how profitable are the strategies after you pay commissions? And so we ran the queries, and the portfolio margin trades that we've been teaching the last couple of years have been very profitable, and you end up keeping about 96% of your profits. Only about 3.6% of the money earned goes for commissions. And if you're patient, then you can execute the trades at the same price that we do or better. When you follow the trade pick service, again, we don't recommend the clients to start the trade when the trade's already making money. So typically the clients will start the trades when they're losing a little bit, and then that way, they get in the trades at the same as the model price or better. And we find that system works really well. The standard margin cost a little bit more, and we found that over the last 2 years, 12% of those profits went to the commissions. And again, that was using, I think, $1 to $1.50 per contract, which means that, again, you have 88% of the profits are yours to keep. And I reiterate, stop gambling. There's really no reason for it. In a matter of days, we can show you a method of trading options that has an extremely high probability of profit, which back-tested very well over the 15-year span. The same exact span and set of data and price moves that totally wiped out the trading account if you were doing that credit spread formula. Trading options does not have to be a gamble. It can actually be executed with very little emotion. Let us show you how to execute a tried and true trading system. It's not hard when you have a mentor who's been through it all to show you how to do it right. Stop gambling. Again, there's really no reason for that. Another thing I want to point out, which is very important, is with SJ Options and SJ Advisor, you get to learn from fellow traders. And you have to remember that many of the educators out there are actually brokers. And this presents a serious conflict of interest. Remember, the bottom line of the broker is to get the trader to trade, to spend money on commissions. SG Options is not like that. We're on your side. Our goal is totally different. Our goal is to develop trading systems that make a profit and actually to spend as little on commissions as possible. We've done the work over the years to develop successful trading systems while brokers have not, which you can see by the back test we presented today. That very trading method was actually published by a very popular trading broker and has been taught to over 1 million traders, sadly enough. Again, why stay stuck with popular strategies that do not work? We can teach you a new approach. How many of you have experienced 10 consecutive winners? How about 20? How about 30? Imagine completing 100 consecutive winners. That's what we just did at San Jose Options. We can teach you a new approach to options trading that's more consistent and far less risky than what you're doing now. Remember, those credit spreads, on any given day, they could lose 5, 10, 15, 20%. In our program, you're going to learn the higher order Greeks. How many of you have heard of Lambda? How many of you understand how to use Lambda? The truth is, and I know this is the truth, that most traders don't even know what Lambda is. This higher order Greek is crucial to your trading success. In just a matter of days, we can actually help you understand it, and you'll be using it in your portfolio, just like a professional trader. Charm. How many of you know what charm is? How many of you understand how to use charm? Again, most option traders have no idea how to use this. Most have never heard of it. We'll show you how to use your charm and how to make your trades charming. VAMA. VAMA is used to dynamically manage your Vega position, and Vega is used to manage volatility. Studies indicate that volatility impacts the portfolio's profit and loss 6 times more than the Greek theta. Therefore, it's essential to become a master at managing volatility, which is done through the V's: VAMA, VANA, Veda, and Vega. SJ Options and SJ Advisor is an expert at volatility trading, and we can show you how to do it in a heartbeat. And simply starting a trade when volatility rank is from 50 to 100 is not the answer. You saw that in today's backtest. VANA is also very important. You'll need to use VANA to manage your Vega. Again, you'll learn this in a matter of days in our program. Gamma. Most of you guys have heard of Gamma, but unfortunately, most option traders do not know how to design trades with a proper Gamma configuration. Again, we'll teach you very quickly. Theta. Every option trader in the world knows what theta is. It's really the focus of the Greeks, but unfortunately, your theta position only accounts for 1/6 of your profit and loss. Your Vega position is much stronger. Trading is all about volatility. We'll show you how to capture theta and how to put it on your side, but in order to really reap the benefits of theta, you have to minimize the risk, and that's what we focus on. So again, at SG Options, we focus on safety first. When you focus on the safety, then you can actually benefit from the theta and from volatility changes and not be hurt by the big moves in the market. While others are losing huge chunks of their accounts, you'll be glad that you learned from SJ Options. You'll be able to sleep in, which I love to do, and you'll pretty much lead a normal life. Other traders will be stuck at their computer screens every single day, losing half of their lives when it's not necessary at all to do that. Think about it. When you're doing those really risky trades, you're stuck at the computer, your life changes. Option trading becomes your life. It becomes a new job. The way that we trade, it's not another job. It's just an extension of an extended resource for you, a resource of income that you don't have to spend so much time at. And you have a lot more free time, and you can sleep in and you can relax, and you're not paranoid. It's a different way to trade, totally different approach. Let the winners come to you. Most traders overtrade. Again, your broker wants you to overtrade. That's how they make their money. That's why they teach these trading methods that require a lot of adjustments, a lot of entries and exits. A lot of traders think the more they trade, the more they're going to make. That's only going to be true if most of your trades are winners. The problem is most of your trades are not winners. So as a client of ours, we'll teach you to become a more patient trader. We'll teach you to only take trades that are optimized for you to make a profit. You'll learn to stay out of the trades that just don't make sense, that have probability working against you. You'll find that you'll have more free time, but also every trade that you make will have a much higher chance of success, and you'll be able to trade less and make more. And this sort of follows, but again, don't try to force your trades. How many of you have really been doing that? You get this options trading fever and you want to trade all the time and you start to force trades and you're just doing things you really should not be doing. It's the wrong approach. It's totally unnecessary, and forcing your trades is just going to lead to just really a negative impact on your portfolio. Control. Control is big. With a safer trading system, you'll find that you're always in control. This is one of the greatest benefits of learning the SJ options method. Most trading strategies, like you saw today, they're full of embedded risk. And when the market moves in the wrong direction, you lose control of your account. When this happens, and I'm sure it's happened to a lot of you, you become a victim of the market. You get whipsawed, you experience large losses, your portfolio ends up in a very dangerous situation. For example, you may have had a credit spread that was only like 2 or 3 days to expire, and you're right up against that short strike and you're risking just large chunks of your portfolio, and you're praying like crazy that you don't lose all your money. Has that ever happened to you? I'm sure it has. It's happened to me. Remember, I started off like you guys, and that's the purpose of having a mentor. So the mentor can teach you to avoid those situations, so you never have to experience them yourself. You don't have to gamble. Stop doing it. There's no reason to gamble. If you feel like you're gambling with your trading, then stop, because you are. With our trading system, you will always be in control. Remember, SJ Options, SJ Advisor is brought to you by real option traders, experienced traders. We've been there before too. Every option trader learns these risky trades first, like the credit spread, like the condor, like the calendar, like the butterfly, the cover call, the naked put. But what separates the good traders from the bad is the good ones have the foresight to move away from the risky trades and learn to master the safer ones. That's what we can teach you here at SJ Options in just a matter of days. Well, thank you for attending this presentation today, whether it's by video or live. It was a pleasure teaching you. Hope you learned a couple of things. And if you have any questions, again, visit sjoptions.com, sjadvisor.com if you're an advisor, or if you're working with a trading group, or if you're managing a fund. Thank you once again. This is Morris, and take care and good luck with your trading.